Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close
The funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. We've got about 18 minutes to go until we wrap up the trade on this Monday, July 21st. Carol Massar, Tim Stenivek, live in our Bloomberg Interactive Brokers studio. And Tim, we are definitely well off our best levels of the session, still above 6,300 on the S&P 500, but we're only up about 17 points. NASDAQ 100, a gain of 145 points, 23,211. I like to do percentages, so let me go there. Up about 0.3% on the S&P 500, up 0.6% on the NASDAQ 100, and little change in terms of a percentage for the Dow Jones Industrial Average. I was just checking.
Check.
Our records, I think we're back on what,
Yeah,
July 17th?
Oh.
62.97.36 was the close
Listen,
for the S&P. So
where we are right now, we're fine.
Yeah.
It's a record. We're set for a record close at this point.
And same thing easily, right, for the NASDAQ 100. Sorry.
I'll take your word for it. I only have the S&P 500 pulled up on my terminal here. All right. Well, I trust you, Carol. Hey, I want to bring in Alan Zafran. He is the co-founder and managing partner over at IEQ Capital. He joins us this afternoon, not from Northern California, but from Southern California in sunny Los Angeles. Alan, good to have you. As always, the S&P 500 up 26.7% from those lows in the early part of April. Is the bull market back on?
Tim and Carol, thanks for having me on. Yes, the bull market is back on, and I can give you a couple reasons why, but it appears as if fundamentally and technically things, barring modest corrections, seem as if every indication is we will continue to work our way gradually higher over time.
Wait, say that again? That was quick. Wait, say that one more time.
I think we're going to move up higher. I think if you look at the technicals on the charts, most components and indices have not hit anywhere near their 52-week highs yet. If you look fundamentally, earnings on balance are coming in better than expected. If you look at this, we talked about this last time I was
Reduced
on.
expectations, though, for those earnings, right? Coming into the cycle.
That's right. That's exactly right. But what's really thrusting this market forward is there's $22 trillion globally of cash, currencies, and money market funds waiting around. And every time we get the proverbial sell-offs of any magnitude on any semblance of hope, let alone fundamentals, the market gets flooded with capital that really started back in 2009, saving us from the great financial crisis. It was only accelerated by money printed fiscally and monetarily from saving us from COVID. And so the world is flush with cash. And every time assets sell off, the cash flows right back into the global financial system, mostly in the form of stocks.
So I'm having a hard time understanding what changed between Liberation Day and now, or so-called Liberation Day, because the tariffs, for all intents and purposes, are set to go into effect on August 1st. We've had some folks on our air today, like Gina Martin-Adams of Bloomberg Intelligence, who Alan says, well, the market's not necessarily pricing in tariffs at this rate for a long period of time. Do you agree with that?
I have a different thesis slightly, which is tariffs are priced in at an effective rate of below 15%, which means, albeit it's not ideal, it's tolerable, and it might reduce a bit global economic growth, but it doesn't put the globe into an economic recession. 30% tariffs are catastrophically bad and would create an economic global recession of some significance. The other thing that's changed is the recognition of just how powerful all of these technological advances are for the growth of profits. It's not just AI, that's a buzzword, but just the rampant use of technology across all forms of business. are meaningfully catapulting productivity, profit margins, and growth. And because the indices, especially in the US is really, when you look under the cover, 40% technology or technology-like kind of companies. So when you look at the indexes going up, that may not be entirely what's going on in Main Street America, but it's what's going on in the US large cap tech overweight stock market that we watch every day.
Hey, I am curious whether it bothers you or it tells you something that's important when we see the Russell 2000, so those small caps, and I always think about what really is the engine of the U.S. economy, those smaller companies that are out there. It is little changed on the year. Also bounced back from those April lows, but little changed on the year. Call it almost unchanged. S&P, meantime, is up about 7.25% year to date. Similar bounce back, but certainly outperformance. NASDAQ 100 is up more than 10% year to date. So definitely some outperformance there. What's the importance, or is it even necessary, that we see small caps rally to suggest to you that things are more optimistic than pessimistic?
It is important. What's hidden a bit in that conversation is a challenge that the financial markets are still grappling with. And that is that when Microsoft went public in the 1980s, it might have had a valuation of about $1 billion or so and grown into its multi-trillion-dollar valuation. And when it was a young company, it was part of the small cap index. Today, when prominent companies like SpaceX, let alone a lot of AI companies, have very high valuations, if and when they go public, they may never end up in the small cap index to begin with. And so part of the challenge that small cap investors face, are we going to see the same champions, many of which are technologically driven with faster growth rates, ever making it into the small cap indices going forward? It is problematic, Carol, because by definition, technology is a smaller component of that index, but that's part of what's taking place.
But what's also happening over that time, Alan, and I know you can speak to this, is the growth of alternative assets and the way that clients of wealth managers are able to get access to some of these companies that you named on a pre-IPO level.
Yeah, they certainly can. However, just like diversification is a way to be protected, when you have very well documented public disclosures of financials and you buy into indexes, it's incredibly challenging to pick the single private company that's going to be the winner. So for those individuals that hope to speculate and invest in private companies, make sure there's an ample array of choices, because you don't have much public disclosure about what's actually happening financially.
Do you do it for your clients, or do you hire managers to do it? What do you do?
Both. So we have managers that will make investments in private companies, technological driven, and companies that have nothing to do with technology. And we have clients where we find private companies where we get access, but we make sure that we invest proper, meaning relatively small percentage of someone's net worth in each component, and stay very diversified. It's impossible to pick the single winner.
All right, we got to run.
Not if you have a time machine.
Are you a time traveler?
No, I'm not. But that
could you imagine if you were?
I would be the best investor ever.
You would, right?
That's all you would need.
Like you just go back in time.
You could invent Facebook, Carol.
I could.
You could invent the Bloomberg terminal.
I could. Well, I don't know about that.
Yeah.
Right. All of it, right?
Yeah, you could.
Just imagine.
That's all you need.
We could do that. I just buy up real estate, you know?
You're thinking now. I know I got the wheels turning.
Sorry. I just buy up real estate. Hey, Alan, thank you so much. Alan Zaffron, co-founder, managing partner of IEQ Capital out there in Los Angeles.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, so many seem to have called it that the bromance wouldn't last between the billionaire and the president. The breakup happening after disruptions to the U.S. government under what some say was the guise of efficiency and data foraging. We are, of course, talking about Elon Musk. He and his black eye, an Oval Office send-off, and subsequent spat with President Trump, the creaking of his empire, and so much more, all in the cover story of the upcoming issue of Bloomberg Businessweek. It is by Bloomberg's Max Chafkin and Ed Ludlow, soon to hit newsstands. It is already, though, Tim, on the Bloomberg and online.
It's also the subject of today's Bloomberg Big Take. With more, great to have back with us Bloomberg Businessweek senior reporter Max Chafkin. He's the co-host of Everybody's Business and the Elon Inc. podcast. He's also the author of The Contrarian, Peter Thiel, and Silicon Valley's Pursuit of Power. He joins us here in the Bloomberg Businessweek studio. You've spent many years writing about Elon Musk. You give us the backdrop. You remind us of his foray into politics. And then you get into what really matters, certainly to investors, and to what made Elon his empire. How bad is it?
I mean, it is challenging.
He's still the wealthiest guy in the world.
I think he's the wealthiest guy in the world, and investors to date have essentially allowed him to do whatever he wants and to do things that most CEOs, most entrepreneurs would never be able to essentially get away with. That said, there are, I'd say, bigger challenges facing these companies today than he's experienced in a very long time. Of course, Elon Musk has a history of sort of flirting with disaster. And you look at the history of Tesla, there were some very dicey moments in the 2000s, same thing with SpaceX. But you haven't had this situation that we have today where you have essentially three companies, SpaceX, Tesla, and XAI. I'm going to leave off the sort of smaller ones, but those are out there too. And then in the foreground, you have this potential fight with Donald Trump. And so, everyone's focused on the fight, but those three companies, each in their own way, have very significant challenges.
So let's get to it, because you do right. There are many more weapons President Trump could deploy against Elon Musk's business interests were he so motivated. So much is like, does he or doesn't he? Let's start. I love the way you guys do this. You do basically like these case studies of each of these three businesses. So let's talk about Tesla. He makes promises. Sometimes it takes longer. We have all gone along from the ride that we eventually get this stuff. And to be fair, when it comes to EVs, certainly in the United States, he moved the needle.
Yeah, absolutely. And that's what's made, I'd say, the events of the last couple of years so surprising, because Elon Musk is attempting this very dramatic pivot away from EVs and towards robotaxis, which is kind of strange because the EV market is still growing very quickly. Mm-hmm. Tesla, on the other hand, is not growing. I mean, their deliveries have been falling for the last 2 quarters, had a down year in 2024. We'll see what this latest quarter looks like when they report earnings, but they are selling fewer cars each quarter than they did a year ago. And that is kind of surprising for a company that is trading at just this insane multiple, trading at a value that is way, way, way richer than a normal car company. Now, of course, the reason investors are going for this, the reason they're continuing to buy the stock at a relatively high price is because of robotaxis, this belief that Elon Musk is going to revolutionize transportation. The issue is that's been this kind of thing that Musk was able to point ahead in the future and say, look, this is going to be great. Don't focus on the now, focus on the future. And now we have the now. Now we have some robotaxis on roads, and it's really a very small number. It's something like 10 to 20 robotaxis in a very small part of Austin. Meanwhile, you got Waymo, and we've talked about this before, but there is this obvious competitor, Waymo, which has way, way more robotaxis in more markets and is not getting valued the way that Elon Musk, the way that Tesla is getting valued. So you do wonder, how long is it before investors start to look at that, and how many quarters of sort of declining deliveries, declining car sales are they really going to tolerate?
These companies have sort of always, Elon Musk's companies have always kind of used one another and shared engineers at certain points. Now we're getting to a point, Max, where Elon wants more investment from one company to another company, specifically Tesla, to invest in XAI, which is a challenging thing to do because Tesla's a public company. XAI is not. Shareholders might not love this idea. Explain the sort of borders or lack thereof when it comes to this accounting.
I mean, the thing is, from the point of view of Tesla investors, and I think this is true of most of the investors in most of Elon Musk's companies, they're not investing in a particular product. They're just investing in Elon Musk. And that's one of the reasons why, even when Musk does something that seems on its face a little bit foolish or crazy, for instance, the on again, off again purchase of X at a ridiculous, overvalued at the time, investors go along with because they just think, okay, Elon Musk wants this. He's a brilliant guy. And so you have this thing where the companies, although they are nominally independent, are sharing resources, sharing management, of course, not just Elon Musk, but other folks, sort of bouncing between them or doing work on the side. And now even you have XAI, which is desperately trying to raising money from Elon Musk's other companies. SpaceX, according to Elon Musk, putting $2 billion into XAI, and then Musk has said he's going to ask Tesla for money and a year ago he suggested the number would be $5 billion. So you're talking about significant amount of money. Tesla, of course, has a lot of cash at the moment. So it's not like it can't afford it. But you got to ask yourself, what is the rationale? Like, what's the business rationale if you're a Tesla investor to, move money from Tesla to X, especially when X and Tesla are sort of in competition. They're both AI companies. And so that's an issue. I mean, what I think it shows is that as much as these companies add up to this big empire, they're interlocking. And if one struggles, the others are going to struggle. If Tesla's value were to decline dramatically, that would hurt Elon Musk's empire in a big way, because Tesla shares are a big source of his wealth, a way he finances things. And beyond that, there's this aura of success that he has used to sort of promote himself and promote these companies. And as that has, I'd say, come into some question, I think that hurts some of these other companies.
So he did post on X that he's back to working 7 days a week and sleeping in his office if my little kids are away. Yay. But I'm just wondering, which part of his empire is he most interested in? You guys talk about XAI, that's what he seems to be super interested in right now.
Yeah, and you get different answers depending on who you talk to within the empire, because, of course, Tesla also feels like employees, board members also feel like they are in the middle of this really unique opportunity with robotaxis. But yeah, I mean, Musk has spent, it seems, at least over the last couple of weeks, a lot of time with XAI and Grok. Now, of course, AI chatbots, that's an area that a lot of investors are excited about. On the other hand, this is a very expensive company to finance. Bloomberg has reported that they're losing $1 billion a month. So like that, $5 billion from Tesla, they're gonna burn through that, pretty quickly. I think from the sort of bull cases, hey, these large language models are really expensive to finance, so we need to, put as much into them now, catch up to OpenAI. But of course, the other side of the coin is like, why does this very successful car company that's worth $1 trillion by market cap, what does it have to do with AI chatbots? I don't think that the answer is a whole lot.
Yeah.
Elon Musk claimed without evidence that President Trump was an accomplice in the crimes of Jeffrey Epstein and alleged that the president had covered them up. This was sort of the nadir in their relationship, I think, if we look back over the last 6 weeks. Is there any recovering from that? Like, do they get back together? Do they become allies again?
I think it is very hard to see. I mean, obviously, those are very serious charges. I mean, sort of like the most serious charges in Republican politics. And it's led to a news cycle, right? That happened, as their feud was kicking off at the beginning of June. Now we're in, mid-late July, and Republicans are still talking about Epstein quite a lot. So yeah, I mean, it's been a bad. That's a thing that's going to really throw a wrench in any kind of potential makeup. Now, I will say, Trump and Musk are both. This is going to sound weird, but they're both kind of forgiving. They both, although they like to cultivate this, both of them, alpha image or whatever, they have, Trump has done this where people have been on the outside and then they find their way in. Steve Bannon, of course, famously was very much on the outs. Now he's no longer on the outs. Musk is the same. Musk, will get very mad at people and find a way to get them back in. So I wouldn't discount it entirely just because, and I've said this on your show before, there are reasons. Each of them has an interest in being on good terms with the other. That said, I mean, it has seemed very difficult. And you're seeing now, we get into this in the story. There are lots of signs, if you're looking closely, for ways in which this relationship is hurting Elon Musk today. Now, I'm not just talking about Jared Isaacman, the person that Trump originally nominated to head NASA, the space agency, who was close to Elon Musk, who's out now. But there are lots of little regulatory moves, policy moves. And just to give you one example, the guy who's going to run NHTSA, at his confirmation hearing, I believe it was last week, suggested that we need to have more oversight of autonomous vehicles. So if
you're Elon Musk, you don't want to hear that when you have a fleet of robotaxis that you're trying to get on the roads.
Yeah, you absolutely don't. And so, Sean Duffy running NASA now, he was, according to at least some reporting from inside the White House, was one of the people who was really upset about Doge. So you're seeing these little things that are potentially troubling if you're Elon Musk, and certainly cut against the sort of bull thesis around the time of the election, which was like, these guys are perfectly aligned. This is going to be amazing. I mean, that's what sent the stock up to its, crazy heights in mid-December. And it's fallen, I think last I looked, around 33% since then, as that argument has sort of fallen apart.
It's, as you guys say, you can't count out Elon ever, but it is curious to see how this ultimately plays out and whether or not he becomes a target of the administration potentially. Hey, Max, thank you so much. Really appreciate it. Bloomberg Businessweek senior reporter Max Chafkin. Max and Ed Ludlow writing this story. It's an upcoming issue of Bloomberg Businessweek. It is the cover story already on the Bloomberg and at Bloomberg.com.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, as we talked about last hour, a lot for investors to make sense of right now. Uncertainty when it comes to trade, questions about the economy. And get this, a chair of the Federal Reserve under attack. Carol, last week you were out. I don't know if you...
I did follow some of this because it did certainly feel amped up.
There was a point last week where it felt like, okay, this is different than the other rhetoric.
Didn't the market dip?
The market dipped, and then the president made comments that said, no, it's not going to happen, and then the market recovered. But get this, just moments ago, I learned that Fox News reporting that Representative Anna Paulina Luna is referring Fed Chair Jay Powell to the Department of Justice for criminal charges. This is according to Fox. They cited Representative Luna's letter to the Department of Justice.
Gosh, so what do you do if you're a CEO in this environment?
Well, Rebecca Humkis is faculty at the London Business School and at Duke Corporate Executive Education. She's also the author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. She joins us not from the UK today, but from South Florida. Professor Humkis, good to have you back with us. The book was written obviously before all of this volatility, but it does seem like for a corporate executive out there, there haven't been many times where there's been volatility such as this. What do you do if you're the CEO of a Fortune 500 company, let's say Coca-Cola, and you find out via a post on social media that you're going to make a change to a product?
Yeah, we are certainly living in different times. Look, you're going to struggle to find a CEO to say that he or she has run their business through certain times. We've always had an element of uncertainty when it comes to planning and preparing, but we have a geopolitical regulatory uncertainty now, which is creating a whole different level of uncertainty, which often borderlines on chaos. And chaos has a cost, which we have to factor into. And we might eventually start to see that pan into how some of these companies start performing over the next couple of years.
Is there a way to sorry, Carol.
No, go ahead. Please.
Is there a way to measure chaos, like some sort of index we could look at, or something like? And look, this is, it's qualitative. It's not necessarily quantitative. But you say that it's a struggle to find a CEO who would say that they led through times that weren't volatile. But I'm just trying to get an idea if this is a more volatile time than in the past.
Well, when we're facing uncertainty, we tend to see three common responses: delusion, paralysis, and chaos, right? Delusion happens where CEOs say, this news isn't going to stick. I've already made a commitment to my shareholders. I'm just going to plow ahead. We see paralysis where CEOs say, let's just wait. Let's just wait until after the Fed meeting. Let's just wait until after the midterm elections. And they delay any type of decision. And we also see frenzy, where we sometimes just see things almost thrown at the market, hoping that something sticks. All of those have a cost, right? Delusion, you miss growth opportunities and go for the wrong ones. Paralysis has both a short-term and a long-term cost. And frenzy has a significant cost, not just on value creation, but to brand confidence that you have both internally and externally for the market. So it is a bit qualitative, but we can actually put indicators across all three of those. And they're what I'm watching right now, especially as we look, of course, what's happened the first 6 months, but also I'm looking for the next couple of years.
So... But there's stuff that's going on in the short term. And I should point out, I am looking at a market that is definitely pulling off its highs of the session. An S&P that's now just up about 18 points, a Dow that's up about 67, and a NASDAQ 100 that's up about 143. I don't know whether it's Jay Powell stuff. I don't know, but it's we have a sensitive market. there's chaos and then there's chaos. There's the financial crisis and then there's, what some would say is a president that could be rather unpredictable. And as predicted, there doesn't seem to be what some say were the guardrails that were in President Trump's first term in the White House. So I don't know. What are CEOs doing? I can't tell whether CEOs are doing things that they're saying publicly and then doing other things behind closed doors. Help me understand so that we have maybe a better understanding.
Well, here's what I'd say, Carol, is as a CEO, tell me the story that you want to tell, and I'll make the data tell that story, right? If you are a proponent of the current administration, things look great. We have relatively low unemployment. We have increasing consumer confidence. We have steady retail sales and stock markets at record highs, right? So I could paint a very bullish story. If you're a critic of the current administration as a CEO, you're painting a different story. You're going one layer deeper under all of those and saying, actually, we're not adding any private sector jobs in the economy. Consumer confidence is still well below it was in Q4 last year. Retail spending is eking up, but largely fueled by credit. So the challenge we have right now is the data is telling a story, but it's a story that you can interpret in the way that you want to, unfortunately, which is largely changed to your political leanings. So we're seeing lots of different reactions in the market. CEOs very much so. I'm seeing a lot more paralysis than I would like. And to go back to our previous conversation, paralysis has a cost, both in the short term, but also the mid to the long term. What we often forget is that growth and performance are a muscle. It's just like going to the gym and working out. If as an organization, you constantly delay decisions, investments, new growth opportunities, hiring, and you delay and delay and delay, you lose that growth and performance muscle. So even when a bit of confidence and certainty comes back, you're not going to be able to do so with the same vigor that you did before. So again, paralysis and waiting too long, if you don't believe either of these stories, which we're seeing a bit as well, that's going to have a cost that we're going to see pan out through the economy. Now, all said, I'm an absolute bull on the American economy and the American consumer, but as a CEO, it's very difficult to plan and prepare through the current environment.
Yeah, no, it's interesting. It's interesting. And I also feel like in the first, term for President Trump, we had a lot of CEOs parading through the White House. I think there are some that have also made their way, but it does seem to be a lot more cautious. And I always get a little nervous about whether or not that is indeed, the CEOs that you talk to, are they able to access the White House if they need to and make their needs known?
It's very circumstantial, Carol, depending on the individual CEO or the company. What we are seeing right now, and we saw it in the Q2 earnings, and we're going to see a bunch more as they come out this week, is a lot of, for lack of a better word, pandering. CEOs mentioning the criticality of U.S. jobs, the criticality of U.S. capacity, and how much that mattered. We're seeing a little bit less action, right? So CEOs are making sure the administration knows that they're listening, they are paying attention, they share some of these agreed values about what we want to do for the American economy. Not all of that is being backed up by action. Look, this is an administration you can get access to, which is probably a credit to the administration. However, you may or may not be aligned with the current way they're trying to approach some of these very real issues, right? We speak a lot about, it's just short term, it's volatile, over the midterm, it'll all pan out. That might be okay if you're one of the largest 100 companies in the U.S., but when you're one of the tens of thousands small to medium-sized businesses that employ this substantial size of the American workforce, you not only don't have that access, you don't have that ability to weather storms that might happen. And we need to think about those organizations as well when we have these conversations.
Can you afford not to get in line behind this administration if you're the CEO of a publicly traded company?
So far, we are seeing no CEO really stepping out and taking that. And that's maybe a surprise, right, to some folks, especially on the left, who did expect a couple of CEOs to stand up and make big brand promises against the administration. We're seeing most CEOs sit on the sidelines, just as we're seeing a lot of decisions sit on the sidelines. You could say that's surprising, but this is also an administration that does come down against those who speaks out about their views. So I expect we see a little bit more of that. Can you afford to? Maybe quietly, but loudly and vocally? We don't have too many examples of that working out very well so far.
All right, going to leave it on that note. Rebecca, good to touch base with you once again. Rebecca Humkest, she's faculty at the London Business School and at Duke Corporate Executive Education. She's also the author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. She's been joining us today from the UK.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Verizon is the best performer in the S&P 500 as we speak, up about
4.5%.
4.5%.
Yeah, not too shabby.
No, it was higher earlier
I think
in the
at
session.
Highs,
Let's hear it, Carol.
I don't know.
5.5%.
Thank you.
You're
So
welcome.
A little bit higher.
All right. Is it going to be one of your gainers today? It'd be a good one.
It is indeed.
Okay. Well, the company posted second quarter revenue that surpassed analyst estimates. It raised its profit outlook. It was buoyed by wireless price increases and recent tax legislation. Here's CEO Hans Vestberg earlier today on Bloomberg TV with Sonali Basak and Katie Greifeld, speaking about the effect of Trump's tax and spending package.
When it comes to the bill that was passed, I mean, there was one piece that is very important for Verizon. That's, of course, the depreciation we can do directly on our capital investment. That have this year an impact of $1.5 billion to $2 billion on our free cash flow. So it's significant. Together with our operation, our cash flow from operation that is improving. That's why we increased our guidance with almost $2 billion in the quarter compared to the financial guidance we had from the beginning of the year. So that's one piece of the bill. The other piece of the bill is, of course, that the government wants to auction out spectrum again. Verizon is in a great position of spectrum today, but, you know, over the time, as we as a country want to be the most digitalized country in the world, spectrum needs to come out for 6G and other technologies going forward. So we're very encouraged to see that as well. It's going to take time before that spectrum comes out for auction, but it's good that the government are thinking long term in this area.
On tax impacts in particular, you know, your earnings are perhaps the more obvious first set of glaring results that show you a benefit immediately. But is this kind of a one-time benefit, or do you see some sort of ripple effect that comes out of that big, beautiful bill for you and maybe even the rest of corporate America, frankly?
So the tax benefit has not impacted our financials yet. That's going to be in the second half and then going into next year because it's a perpetual sort of benefit we have. So that will continue. So, but I think for us, we are very disciplined with our capital. We already increased our capital for 2025 compared to 2024. Now we have our Frontier acquisition pending. We're waiting for the last approvals here. When that comes in, of course, we're going to make a holistic view how we're going to do capital allocation going forward. But always we put first priority in the business. Number two, we have increased our dividend 18 consecutive years, and we're going to put our board in a position to do that. And then we're paying down our debt to get to our leverage ratio. And after that, including Frontier, we're also going to come to buybacks. We're going to package that in the next couple of months and talk to the market how we see about capital allocation and the benefits of incorporating Frontier when that's approved.
That was Verizon CEO Hans Vestberg earlier today on Bloomberg Television. Well, I want to bring in Kelsey Griffiths, a Bloomberg News telecom reporter. She follows the space and the company closely. She joins us from our Washington, D.C. bureau. Kelsey, there was this moment during at least that clip that Carol and I both went, And it has to do with spectrum and the idea of spectrum and how Hans Vestberg talked a little bit about being interested in buying more spectrum for the company's network. Can you kind of explain how this stuff works?
Sure thing. So spectrum is a big deal here in Washington. In the Big Beautiful Bill, the Congress decided to allocate 800 megahertz of spectrum for auction or repurposing. And in the wireless space, that's a huge deal. Spectrum licenses cost millions and millions of dollars, and they actually add to the portfolio of infrastructure that the mobile carriers can build. It offers this bigger runway to allow more customers and more data on the network. And so that's why that's sort of this lifeblood that keeps the industry moving forward. Now, we did hear Vestberg say that Verizon has a pretty good spectrum portfolio right now, so he's not necessarily worried about the next year or even the next 5 years. I think having Congress thinking about and kind of planning for the future spectrum needs gives them that runway and a bit of assurance that they will be able to grow in the coming years.
Is it a finite resource?
It is. It is a electromagnetic engineering principle. We can only have so much data on the airwaves, only so many users can be on them at one time, and it's the same principle that constrains the TV airwaves or the TV channels that you're able to pick up.
So does it get to a point where we are looking for so much data that there's not enough spectrum to accommodate what we need?
I've asked many engineers and telecom experts about this over the years, and everyone has assured me that we're not coming up into a spectrum crunch yet. As technology advances, they've found ways to get more data on higher spectrum bands. So we're able to use the resources that we have more efficiently. But, who's to say? Maybe there is a day when we start to run out. So far, I haven't heard that from the experts.
Well, I do have an anecdote that I've been thinking about that maybe I could ask Hans Vestager about, Kelsey. But here in New York, I know this is not an issue for you because you live in D.C., but here in New York, there's no service between stations for cell phones, but once you get to a station, there is service. And one thing that I've found is that over the last few months, or maybe over the last few months, during rush hour, you can't really use your phone in these stations anymore. And I'm wondering if it's because we are using more and more data as consumers that these networks, when they're crowded, are just completely overcrowded. And it seems to be like when we get, more advanced phones, when we do more with our phones, we're just using more and more data.
When we want to play Wordle on the way home and we can't because we can't get it on the phone.
Yeah, is there some truth to that?
Yeah, that's exactly right. Like you're saying, these networks are finite resources, and there's only so much data that you can kind of cram through the pipe. So these carriers are trying to add more spectrum bands to their network to kind of open up those lanes a bit. They can also do some things locally, like adding more 5G small cells, adding receptors underground to make those signals kind of travel through the concrete a little bit more easily. But yeah, there's a lot of things that they can do to kind of relieve the pressure on the networks as that builds, and I think that's what you're seeing.
But do we at some point max out? Is that the possibility? Or is that the question that, again, you say nobody...
She asks over and over again, and so do we, and she says no.
Tim and I are sitting here like, so wait, is there a point where
we're going to get hit in the face with spectrum, Carol, and we'll be okay.
I'm going to go back to party lines.
It's really funny because when you talk to some of these spectrum experts, and when you talk to people who've worked at the Federal Communications Commission for a long time, there are slices of the airwaves that used to be considered junk bands, and now they're bringing in millions or even billions of dollars for these licenses. So as technology marches on, our use of the airwaves can, get more efficient, but it also means that can bring really valuable spectrum licenses to market. So we might be seeing that, as the technology advances.
Well, just one more question on this, Kelsey. So I just think about those that don't still have access, right? The underdeveloped parts of the country where the infrastructure maybe isn't there in terms of spectrum or service. Do they constantly get squeezed out because of the dense areas that just really need it?
Yeah, so you raise a really good point. Spectrum exists, above our heads. You just have to have the technology available to sort of capture it and make use of it. And in these urban areas, obviously usage is really dense. And so that's why it takes this really big network investment to create the infrastructure that lets you get that benefit of the spectrum. In rural areas, there's maybe less of a case for investment in that infrastructure that would allow residents in that area to make use of the spectrum that's already over their heads. So I think that's kind of where the tension is there. Companies need that incentive to build the macro towers and to build the 5G small cells that will let people have that access.
I am wondering why shares are higher even after the company saw a net loss of 51,000 monthly consumer wireless phone subscribers. Analysts were calling for 12,000 in terms of a net gain. What happened here?
Yeah, we're seeing a really interesting dynamic here. I think that the company for a long time has been encouraging us to not only look at subscriber numbers, but to look at their overall growth. We saw growth in the broadband sector, where Verizon is not only becoming your mobile phone provider, they're increasingly becoming your home internet provider as well. And that's become a big bright spot for them. We see them gearing up to invest in more infrastructure like we were just talking about. So I think they're trying to kind of steer us away from looking at that one single metric of how many consumers they gained or lost in any one quarter. I think we're seeing the market maybe responding to this longer term picture picture that Verizon has been, trying to kind of sell us on.
Where does Verizon kind of stack up against, its competitors, its peers?
Yeah, so Verizon is the biggest mobile customer, I guess. It has the most mobile customers, followed by T-Mobile and then AT&T. And each of these companies has sort of their own personalities. I think Verizon is seen as sort of this like slow and steady giant. They talk a lot about disciplined growth and really wanting to make sure that they keep pace and are competitive, but they're making these really smart investments. Of course, the same can be said for for the other peers as well. But I think AT&T has made a really big fiber bet. They talk a lot about convergence and doing these bundled offerings to give you home internet, streaming services, and also your mobile phone service. And then for T-Mobile, I think we see them as this big, splashy, company that's great with marketing campaigns, great with bringing celebrity talent in. So I think they each play well in this space and kind of have their strengths. So that's what we're seeing from Verizon.
All right, just 30 seconds or 20 seconds here. The acquisition of Frontier, what's it going to do?
So in short, this would expand Verizon's ability to reach home internet customers with direct wired connections. That means fast service. That means no latency or virtually none. And that means you won't have to rely on your phone's 5G signal to try to stream Netflix.
Interesting stuff. Well, investors definitely taking note of Verizon on this Monday. As we mentioned, it's the number one gainer in the S&P 500. It's up about 4.5% as we speak. So investors definitely moving into that one. Kelsey, thanks. Kelsey Griffiths, she is telecom reporter at Bloomberg News, joining us from our bureau in the nation's capital.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.